So it was very difficult. The transition was very difficult. I loved the art of a real estate deal. It was like a nail in the coffin. I remember that seminar in itself made me very decisive to decide that was the business I was going to go into. The tax advantages, cost segregation, and bonus depreciation, 100% bonus depreciation in year one with this big fat bill or whatever. The apartment building is only valuable when it produces a profit, and a certain amount of profit to where investors can get a good enough share for their money. To make profit, we have to fill the units with good paying tenants. Our expenses were double what his were. And the problem is he had a 25% expense ratio. That to me is very unrealistic, especially when you are taking into consideration investors that need to be paid back money plus profit. We're really looking to help investors obtain freedom. Cost segregation and bonus depreciation benefits 100% in year one thanks to the big, beautiful bill. Stop missing out on your kid's life, on your wife's life, on your life that is continuing to tick away. And let us professionals go in and do it for you. To invest passively, you have to give up control. If we meet those numbers on a weekly basis, then we know that we're staying consistent with our goals. You have to put your money to work and let it work for you passively, especially if you're looking to fund the next generation. That's literally risk mitigation. It's by getting experts in the field that know what they're talking about. It's more risky for you to go in by yourself. That is one way we leverage your wealth into a higher, more expensive asset that produces cash flow that we have some control over. The fear of loss controls every decision an investor makes. Kind of just the way it is, and it's almost part of the fun of investing in a deal. So we bring on experts to manage this specific property to bring superior results. Investors are really missing out on big opportunities. We're looking to bring institutional sized deals to your doorstep, okay, so you can act today on the next deal if you wanted to. If you want freedom in retirement, to go into retirement stress-free, you have to give up some of this control. And we're here to help you do that and protect thousands, if not millions of dollars with a hard asset that cash flows that will live past your lifetime. Okay? All right, let's go. Let's get this close. Let's go. Let's do it. Let's do it. Let's do it. My coffee here. Yeah, no, let's do this for sure. My first question is, why did I get into multifamily investing? Got to rewind a little bit because I got into multifamily because after I left my work in the military, I wanted to go from hourly salary work to like sales or commission only, because I wanted to have a little bit more control of my income, because I remember towards the end of what I was doing for the government in the military, I knew it wasn't going to be long-term fulfilling for me, especially with only 14 days paid off vacation a year. I knew there was something wrong with that. So I don't know if I think originally I wanted to get into insurance. I actually got, went through getting my license and taking the test and going through all that, specifically in like life, health insurance. But then I met a friend of a friend who is in the mortgage residential business. For some reason, I thought that was a better decision. Looking back now, I think I probably should have stayed in insurance, but I got into the lending business. I was in the lending business for a very short period of time. I got into the market in a 30-year, it's the worst it's been in 30 years. So it was very difficult. The transition was very difficult. And I only kind of have myself to blame for that. It was just hard. It was a hard time. So I stayed in the real estate industry, but I started doing more video marketing, sales, advertising, graphic design, um, and drone, of course. And we did help businesses seek, some success specifically in that industry. And then I think at some point I got introduced to acquisitions. I got introduced to Dan Pena's QLA model, the Quantum Leap Advantage model. And I think for the last decade, I've wanted to take a quantum leap. And really what that looked like to me was, it was either starting my own gig, starting my own company so I could make a lot of money. But I started to learn over time that acquiring an already profiting business was actually the way to go, to really help get yourself to success. That means a lot of different things to a lot of people, but it's how to obtain large amount of wealth in the quickest time frame possible, leveraging other people's assets and money. And I knew that was something I wanted to get into. I think it started in I wanted to acquire real estate style businesses. I don't really know why I stayed in that. I just think I knew the vocab. I was in the industry. I understood kind of what was going on. I loved the art of a real estate deal. And frankly, I knew there was money to be made in that. I knew there was money to be made in real estate, both in short term, long term. And, there were companies that really mastered the art of both. So I knew, for me, there was a certain level of wealth I'm looking to obtain. There's only a few amount of vehicles that could actually get me to that. Real estate was one of them. And then I can't remember exactly when I got exposed to multifamily exactly. I learned that in multifamily you could purchase an asset with none of your own money. And that was really what I was looking to do, was how could I bring value to the business in other ways and actually get paid for it instead of actually putting my own money into it. Because when you think of buying a business, you have to bring out, pull out a check. But it doesn't quite work like that when you understand how you can finance a deal in the right way, using other people's assets and money. Very important. So I just knew I had learned. I think I actually went to the multifamily mindset class 3 years ago. And then it was like a nail in the coffin. I remember that seminar in itself was very, made me very decisive to decide that was the business I was going to go into. The fees are huge. The checks are huger. It kind of put me in a position where I could obtain $100 million of wealth for myself. I know that's crazy, but to obtain that amount of wealth, you really have to have the right vehicle. And multifamily real estate helps me accomplish that in multiple different ways that I'll go into further in our conversation today. Okay, let's talk about the repositioning of units. These are just kind of questions. They're not necessarily in order, so let's just stay focused until the end. I'll probably answer a lot of these questions, and they'll kind of all intermingle at once, just so you're aware at the start. The process of repositioning units. Our value add strategy is going in, doing minor renovations on units, put it at the best quality, and actually charge a premium over market for that unit. How we do that is after we close and start transitioning, we'll usually start with the vacant units first. We'll renovate those because it's probably going to be between 10 and 12% of the building or of the units. And we'll do those first. Then we'll provide an incentive to the tenants already living there that they can move into those units, because what we have to do is then go into the units that they were living in, right? There's got to be a moment that they're vacant so we can go in, reposition the unit, do a minor renovations between, nationwide is between 3 to 8. It just gets super local in terms of what your materials are going to cost and what the labor is going to cost and what the construction is going to cost. That stuff kind of fluctuates depending on region. So it's important they have like an asset manager or people that are very grassroots to your community that'll give you the best value add. So we'll go in and try to do 15% of units over a 5-year hold, which actually might be too many because we want to leave about 25 to 30% of the units open for the next buyer when we exit. And we'll hold it for about 5 to 7 years just to ensure that we can get all the units done and prepared to exit. And we reposition with new counters, stainless steel appliances, vinyl planking, new windows, painted doors, new paint inside. And then we implement this into our CapEx budget. And it's very deal specific. So, if you're an investor looking to possibly invest in multifamily real estate, so that is protected by a hard asset and you can get 100% bonus depreciation in year one, thanks to the big, beautiful bill. We'd have to schedule a time, and then I couldn't get you in until the next deal was available. Okay, so just so you know. Do we have a buy box? Do you have a buy box? Yeah. We have a buy box and we have a model. Okay, so really our model is a minor reposition, value add, and exit. Some of the parameters of our buy box are definitely fluid right now. We're out of Nashville, we're out of Denver, we're out of Washington. We're strictly only in Florida, specifically MSAs around Jacksonville, maybe Orlando, but not waterside, not within 25 miles waterside. Really C plus B minus properties with no major renovations. We don't want to go in. We'll consider doing a roof, but we're not going to do foundation. We're not going to do major exterior renovations, any units that have been, damaged that people can't live in right now. Mold problems, like we're going to go through, an entire physical due diligence process with each unit. And I feel like there's something I'm missing on there. MSAs. Only minor repositioning. So we're really looking at 95 vintage or newer. Probably 2005 is going to be more ideal because we're already going on a 20-year mark. We do 5-year hold-ish, 50 to 150 units. It's hard for us to compete on units that are bigger than that. And we're bringing in sponsors on these deals, and that's something to consider when we're getting debt on the property. So we're really only between 50 and 150 units. Reposition of $3,000 to $8,000 a unit. We're looking to install washer and dryers in the unit. Those are basic value adds that increase the revenue of the property, okay, and ultimately increase the net operating income of the property, right? Because that's the value of multifamily. We'll get into that further if you're looking for more of a long form way of breaking into what a deal looks like, how we underwrite it, and what we're looking for. Somewhere there's going to be a link. It might be in my bio, but you can just click it just so you can see what's going on. Because, each multifamily managing partner company, they're all going to be different in their own way. Okay. And it also depends on if we don't want to bring in institutional funding because it's hard for us to compete on those 150 plus units. We got to buy at a higher cap rate so we can go in and stabilize the property. But those guys can purchase at a lower cap rate, and we're really looking to make a difference in the cap rate. So that's just something to take into consideration. Are we doing 12 minutes? Okay. Why are you not investing in Washington? One, gas is too expensive. No, I think there are definitely deals there. I met I know a guy, I know two guys who only invest in Washington, right? So it's not just for me. There's definitely the right investors for deals in the state of Washington, and we're talking about the state of Washington, and specifically the northwestern part of the state, which is like the northern part of the peninsula, Seattle, Everett, Marysville, Skagit Valley, Whidbey Island, and Bellingham. Because that's really all that I really was like the only areas I know. But really, there's really only, specific markets where 50 plus units are being built. And most of them are in Seattle, Everett. I don't know if there's one in Marysville or not. But there's some in Bellingham, but I would never, ever invest in Bellingham. It's just personal. I think it's a super dirty town. Very sad of the condition that it's in right now. And it's tenant friendly. It's just super unsafe. All the above, just all that combined. Definitely not looking to invest in those areas of Washington. I mean, maybe if we looked at a different property, but it just does. I don't think it would really make sense for us to do to invest there, just because we don't want to spread ourselves too thin. How do you actually make money on a multifamily investment? Okay, yeah, there's really, as a passive investor, there's two ways you make money on the deal. One is through quarterly distributions, and those are calculated based on the percent profit that we receive on the income. You receive one of those every quarter, simply just deposit it into your account. And then the second way you make money is on the sale of the property. So, for example, if you're an investor, we had a 5-year hold, you got paid every quarter with distributions. At the sale of the property, we'll make a profit. So if we bought for $2 million and we sell for $4 million, you're going to get a percentage of the $2 million we made profit. Okay, you'll get a percentage of that. And it just depends on how much you invested, what percentage you are in the LP side. There's just a couple of numbers that will determine that number, but those are the two ways that you make money on the deal. And then you really need to consider the tax advantages, cost segregation, and bonus depreciation. 100% bonus depreciation in year one with the big fat bill or whatever. That technically increases your income because you use that against all of your income, all of your personal income, not just on the income that you receive on the real estate. So that's how you make money on investing in multifamily real estate. Okay. What is a multifamily syndication? Okay, first, there's multiple ways you can buy an apartment. Okay, syndication is one of them. A multifamily syndication is a group investment that has several investors involved. How do I say this? That's not the right way. I may need to look up the definition. So multifamily syndication is a group investment where several investors pool their capital to buy a large apartment property that would be difficult or impossible to buy individually. Okay, so the syndicator finds the deal, finances the deal, manages the deal, and oversees the deal. Okay, the investors or the limited partners on the deal contribute capital, receive the share of cash flow, and take on limited responsibility on the property. This is where you receive truly passive income with your wealth. So it's essentially a structured partnership to acquire, operate, and profit from multifamily buildings at a larger scale. Instead of just working individually, we come in with a team of experts that underwrite the deal, raise capital for the deal, sponsor the deal, and manage the deal to extract the most profit from a deal and actually protect your money at a greater scale, because the more units is less risk which is ironic, contrary to what you've been told. But the more units, the less risk, and that's something to take in consideration if you're looking to be a part of a syndication. So that's how it works. Our syndications are GPLB split, and that's all. Okay, I really want to dive into why market research is so important, okay? So, as you know, the apartment building is only valuable when it produces a profit, and a certain amount of profit to where investors can get a good enough share for their money. To make profit, we have to fill the units with good paying tenants. Okay. So really the first set of risk management is market research and determining where are we going to put our capital and where are we going to look at deals and where are we going to even consider going into further underwriting on these deals, because you can eliminate a lot of markets without having to do that much market research. Okay. So, and plus we have to ensure that there's enough demand to have our unit filled through the entire hold period and that it doesn't change during a certain market. And there's ways we mitigate this. Okay. And it starts with market research. So there's information that we gather. We look into building permits. Are there tons of new builds coming onto the market that will compete with us? Okay. Nicer looking apartment buildings with better incentives, maybe. Price trends. Are rents in that market consistently increasing or decreasing in value? You have to look into it, but usually if an entire market sees a decrease in rental income, that means that there's too many apartments on the market and there's not enough people to fill those units. That's a sign of risk. Okay. Over time, the age of the population, and does it match the age distribution in terms of the structure of the building? So that's why we don't look for studio heavy apartment buildings. There's higher turnover in a studio heavy apartment building. And one person may rent a 2-bedroom, but someone who needs a 2-bedroom may not rent a studio, if that makes sense. Especially when you're talking about families and couples together. Okay, so we don't love to see a building if it has 300 units where 180 of them are studios. Okay, we don't like to see that. What else? Migration patterns. Are people in general moving or leaving an area? Okay, that's why Florida just kind of came onto our radar. It comes down to like a sub-market level, right? So you can't really look at it at a state level. Maybe there's more people moving into Florida, but maybe more people are moving into Naples or Daytona Beach or Miami, right? Instead of Orlando or Jacksonville. And then when it comes to physical and financial due diligence to ensure that we maintain our CapEx budget, that all the units don't need major renovations and that they're in decent condition, we look at all major foundational things, such as roof, foundations, exterior paint, and then plus we need to verify the rental income. Do the financial statements verify on the rent roll and the T12, and do we calculate a similar net operating income on the property? Does the market cap rate match what the cap rates are selling in that market right now? Like, we look at all this stuff just so we can put ourselves in the best position to buy a profitable multifamily property, because there's always risk in these investments, right? You know that. I know that. And it's just so important that we set ourselves up for success by doing the basic underwriting of the market in the first place, right? When we can put ourselves in a much better position when we do that. So that's why it's so important to do market research. Is there anything I'm missing? Bad deal. Oh, and lastly, market research is an ongoing process. It's never ending. And so, because markets can change in a 3 to 5 year period. So that's why it's so important to do your market research. Okay. Tell us the deal in Blackhawk. Okay. So I originally had a buy box here in the state of Colorado, and that's where I'm at right now. And there was one in Blackhawk. Ironically, I was looking at rentals in Blackhawk. Okay. So I got a hold of the broker because aesthetically it was perfect. It was a brand new build, a beautiful building, set at the top of the mountain. You literally had a penthouse suite there. And there was going to be a $1.5 billion casino that was going to be built in town. And so I believed it was something worthy to go look at. But my first mistake was before you go look at a property to underwrite, you should just underwrite the deal. Do your basic underwriting on the deal prior to even contacting the broker. Because just based on the OM of the property that I got from the listing broker, our expenses were double what his were. And the problem is he had a 25% expense ratio. That to me is very unrealistic, especially when you are taking into consideration investors that need to be paid back money plus profit, right? So just that in itself, because we're valuing the value of the property based on the operating income. It's income based, not like market based per se, right? It was a pretty low cap rate actually, and so they were double of what we thought. If I had done the deal, he wanted 5.8. Even if I did the deal at 4.8, I would have lost my investors so much money, and it's ultimately an investor's worst nightmare, right? To lose your investors' money even after you sell, that doesn't necessarily mean it was a bad deal. For me, it wasn't right, okay? Because I'd have to bring in investors and they'd have to make their share of money. And we considered bringing in the seller as an asset manager and a sponsor, but there's just no way. I would have only offered $3.2 million on a property he wanted 5.8 for. So it just wasn't the right deal for us. But I think it's very telling of where we're at in the market in terms of the cycle, because it shows that sellers are wanting more than probably what the property's valued at. So it'll be very interesting to see what that property does. It just came on the market. Like I said, someone's going to buy that deal. It's an amazing deal. It really is. But it just goes to show if you want a deal bad enough, you'll do a bad deal. And that's a perfect example. Why am I not investing in Colorado? So although I'm from the Mile High City, we've taken multifamily here out of our buy box. Why? We're going through an oversupply right now. There's tons of new builds, both single family and apartment buildings. And not everywhere, but I mean, along every major highway or road, there are tons of apartments being built. And I think it's going to become very saturated with A-class and B-class properties, which is just presents competition in our space. And they don't build 50 to 150 units everywhere. That's something to take into consideration. A lot of them are brand new builds, so those might be very valuable in 2 to 3 years if they drop in price. But I just don't think there's too much demand here, and I'm not very confident in a business plan in any of those markets that have 50 to 150 units. So that's why I'm not investing in my hometown. What's the biggest problem passive investors face when trying to invest in Florida real estate? A lot of problems. There's a lot of reasons investors have problems. I believe it's the inability to find vetted opportunities and the vetted professionals that are going to help you execute a successful business plan. Usually investors are very high-level professionals, usually don't have a lot of time available. In Florida specifically, there's deal scarcity there in Florida, competing with, buyers from literally the world. And then, really a lot of those deals are off market. So it's how do you find those deals? And then, of course, in Florida in particular, rising insurance rates are sometimes a problem, but to us, it's just something we accept. The syndications, they can be complex, especially when there's a lot of investors involved. And the lack of trusted operators, like I said, to fulfill the business plan, because it's more important than just raising the capital, is being able to fulfill on a profitable business plan. And so really what our company does, or just what syndicators do in general, is we have a team that vets the deal, underwrites the deal, ensures we have sponsors. Let me rephrase that. So like our team, we vet deals, we underwrite deals, and we bring the right sponsors and professionals in on the deal, so that way you can begin passively investing passively without having to do any of the work. You just receive quarterly distributions. Okay, we'll bring the institutional deals to you so we can help you get in some of those deals. Okay, so you can diversify your income, protect it with a hard asset, get bonus depreciation 100% in year one with the big, beautiful bill. Okay, so those are some problems, and that's how we mitigate some of those problems. Okay. Okay, why is multifamily one of the safest places to put capital today? With all investment, there's always risk, and we mitigate our risk by a collection of market research, capital expenditure budget, reserves, and of course, the physical real estate itself is a hard asset that brings tons of stability and protection, even for super large amounts of wealth. Okay, we review the demand, we review stability, just tons of wealth can be protected in multifamily real estate. So we review the demand of the real estate, population growth of the area, rental pressures in Florida specifically, how many are being built, what are the market trends, is rent increasing or decreasing, is there a constant demand for living, have we seen decreasing rental rates. It brings in stability against a volatile stock market that can quickly eliminate a lifetime worth of wealth without anything to recoup it, right? In the worst case scenario, even if our building went 100% vacant, we had to kick everyone out, even if it was destroyed in a hurricane, we have insurance to help protect us, and ultimately the value of the building has some value in itself, right? So, I mean, through an unsuccessful business plan, you would lose that to foreclosure. So it's just very important to get the right operators in on the deal, and that comes in many different ways. Not to mention the tax advantages of cost segregation and bonus depreciation 100% in year one. Okay? I've said it once and I'll say it again. 100% bonus depreciation in year one with the big, beautiful bill. Okay? That's how you can not only mitigate tax for the income on the property that you're receiving as a passive investor, but against your other income as well. So that technically increases your returnings, because the tax and debt game is a game in itself. Okay. But really, most importantly, it's the hard asset that protects you. And of course, you can begin diversifying against different markets, across different classes. Just in multifamily itself, you have different ways of diversifying. So that's how you protect yourself. What mistakes do new passive investors usually make? Passive investors who are getting into deals without vetting operators and assessing the risk. How do I say this? Investors jump into deals without vetting operators and being able to act upon a successful business plan. And there's real risk. There's real risk when it comes to these investments, and jumping into an opportunity could lead you down a bad path. So, as a syndicator, our syndication is, complex. You need many on a team, including investors, asset managers, capital partners, loan guarantors, debt friends, and you got to meet legal compliance and have the right sponsors on the team, someone who can oversee the project to success. So it's really easy to be swayed by returns, high projected returns, over the fundamentals of what it takes for a team to succeed, especially in 50 to 150 plus units. We're talking, it can be institutional sized. And so I think investors just kind of underestimate basic risk in an investment of itself. And how do you actually read and mitigate those risks in a deal? And even just the lack of focus on a super hyper local market, you can get spread too thin. And remember, a lot of these deals are off market or pocket listings. And so you're not going to find them on the internet. And that's just something to consider. The inability to go to the market and visit, or once being in the market, or okay with going to the market. I think there's a lot of value in being able to walk these properties and physically seeing what the property is like and how it feels being there. That's very important. That not every business is the same way, but in real estate, it's very much that way. And so, for example, I had a mentor who he foreclosed on a property because he didn't mitigate the risk of bridge loan debt, adjustable rate debt that hit, when we went through payment shock a couple years ago. Investors make mistakes, guys, and there is real risk when investing in these properties. Okay, and you have to be able to understand that as an investor going in. And really, that story it's shocking, right? And when you hear stories, or if you're that investor who lost money on that deal, it's very hard to get into the next deal because you have the fear of loss potential, and you grieved over the loss potential. And so that's very important. As a business, we very much take that into consideration on how we're going to return our investors their fair share of profit. But there's always risk, even with us, right? So don't get into new deals without vetting the right people or having a vetting team. We can be your vetting team for you, okay? Why is it so hard to find good deals in Florida right now? Tons of investors in Florida. Makes it very competitive because we're not just dealing with national but international buyers. Recent insurance increases have affected underwriting, and I think there was a huge supply chain that came in, built a bunch of new units, which is going to bring competition to the market. It's going to affect what the market looks like, and but just in general, people are moving to Florida. It's a landlord-friendly state. And there's good units being built. I think that's important. You got to find the right places where these type of buildings are available, and they're not available everywhere. But Florida, in certain markets, have those kind of places. Back to insurance. lower cap rate, if you're buying at a lower cap rate, especially with institutional side multifamily, you really got to consider the expertise that needs to be on the deal to oversee the business plan. Because if we're selling with the inability to sell at a lower cap rate, we're actually losing money if we buy at one cap rate and it increases. And that's a little bit of equity is lost there, and we don't want to do that. We actually are trying to get a full percent difference, because just in that, there's money to be made. And what might happen is, if the market is seeing less demand, the cap rate's going to increase. So that's why it's so important that we understand that there's enough demand to fill the whole hold period. Because we got to take into consider that cap rate. And going back to why it's really hard for us to compete on 150 plus units, it's just because with smaller private equity groups, really hard to profit when you have little cap rate room to work with, especially because we got to go in and stabilize the asset if it's not stabilized. So that's why we kind of like to look at stabilized assets. If it's unstabilized, we only like to look at within 5%. So it's got to be at least 80% or more, because we got to get debt against the property too, and we got to ensure that we can fill the units that we renovate. So that just makes a deal hard to find in general. What fears do passive investors have? Investors are scared of losing money. That's number one. Number two is not having the right team. I think investors understand that to get 50 plus units, it's going to take a team, but it's the inability to properly find the right vetted deals, get in front of them, and execute on a successful business plan, right? Which comes in with an asset manager, sponsors, mentors, all those people. So you need to get someone who's dedicated to succeeding in this business. And that's kind of what we do as a group, okay? Another thing is investors are scared to find hidden issues inside the deal. Whether it's physical to the property, that could be catastrophic to the physical condition of the building itself. Economic representation, were there things that were lied on during negotiations that didn't come out until after the deal was done? That could potentially jeopardize the deal. And it's not just, we're talking about huge amounts of wealth. We're talking about millions, potentially tens of millions of dollars, not only for you to lose, but for other investors to lose. And the fear of loss is the number one problem for investors. Okay. And I think another thing is timing the market incorrectly. Buying too high. We talked about cap rate, not being able to sell or exit after the hold, right? If the exit plan doesn't come to fruition, there's a lot of fear there. And these have the potential to wipe out lifetime earnings of wealth. And that's very scary. It can paralyze an investor. Okay. This is why investors fear investing in general. And that's why investors have their own set of mitigated risk. Let's get on to this next one and then we'll take a pause. What does passive income truly mean for an investor? Our group, we're really looking to help investors obtain freedom. The ability to do whatever, whenever, however you want to do it. Okay. It's money working without your effort in exchange for time. And we accomplish this by implementing the right team to vet the right deals, to implement the right property management companies that are vetted by professionals in the industry. And instead of working for that, it's a predictable quarterly distribution that just shows up while you rest. That is more stable than it's more stable than the stock market, and it's protected by a hard asset. And with the maximum cost segregation and bonus depreciation benefits, 100% in year one, thanks to the big, beautiful bill. Okay, not only for your income, but for not just from income on the real estate, but for income in your personal life as well. Okay. This allows it to be more predictable instead of working in your business day to day. So you can spend time with your family and live your life to the fullest. Stop missing out on your kid's life, on your wife's life, on your life that is continuing to tick away. And let us professionals go in and do it for you. I run these properties. I'm helping manage these properties. I'm going there, flying there, seeing this person, calling this person, and making sure this is right. I got your back. But to invest passively, you have to give up control. To obtain freedom, you have to give up control. And this investing in multifamily is one strategy to help you do that. It's not the only strategy, but it is one strategy to help you do that. Okay? That's why it's essential for everyone to understand how to get into passive investing. Learn how to become a passive investor. Okay. What separates trustworthy operators in our syndications and throughout the life of the syndication, we get consistent reporting in terms of waterfall of communication that we review on a daily, weekly, monthly, and quarterly basis. Okay. We report when it kind of starts with property management reports on a weekly basis. It's very basic numbers. What vacancy are we reaching? What is our potential income? What is our scheduled income? And what's coming out of the business? Okay. If we meet those numbers on a weekly basis, then we know that we're staying consistent with our goals. Okay. With our model in particular, kind of falls on the asset manager and the sponsor, right? Because we're a little more renovation heavy and construction heavy, especially since we're going in and doing value add. So it's important that that's a trusted operator, specifically one who's probably been really successful in that specific local market before or currently. Okay. And then we let the data tell us what's going on. We really need high level grassroots teams, people that are literally in that market day to day that are working on the property itself. The asset manager doesn't necessarily need to be in the market, but the property management company, obviously needs to be super hyper local. And in our value add strategies, we need to trust that they can oversee those projects and are meeting them by goal deadline. The asset manager leads the property management team that are building day in and day out. Okay. And we also believe that tightening management, especially if we see like a high payroll or high maintenance fees in underwriting, we can go in and squeeze and straighten that up. That can be a great value add opportunity. Okay. Let's pause there. How does passive investing help investors overcome their financial doubts? This question is going to be really specific to just multifamily investing in general. Okay. When you're investing in multifamily, if you're not already a multifamily investor, you're diversifying your income. Okay. There's different ways of investing in multifamily, whether it's through appreciation, through value add, through cash flow, depending on it really depends on your investing goals, because each one's just a little bit different, and the diversification is protected by a hard asset, and then you can additionally diversify further by investing in different geographical markets. So this helps reduce the emotional swings that you might experience through the changing of markets, and it mitigates some of the risk if the market doesn't turn into our favor, whether that's during the hold period or at exit. Okay, and another piece of this is investing passively. When it comes to actively investing, you only have so much time to do things, okay? And the clock keeps ticking and you watch your life move in front of your own eyes. You watch it go by like a clock, okay? Just like you're on a road trip, you watch the land just go by you, okay? But you're not getting any younger, and you can leverage passive. I need you to hear me when I say this. You can leverage passive investments to increase your income without exhausting more time. Actually, if you become more of a passive investor, you reduce the time you work, okay? And if you want your wealth, this is just logical. If you want your wealth to live past your lifetime, then you have to become a passive investor. Does that make sense? You have to put your money to work and let it work for you passively, especially if you're looking to fund the next generation. Generational wealth. You have to learn how to become the best passive investor. Okay? And this is really important if you're looking to retire, right? To put you into retirement stress-free. Okay, quit worrying about not missing time. Damn it. You just want to work while everyone around you gets older. You miss out on things and events and experiences. You're not coming back to life. Okay? Just really take that into consideration. And plus, don't forget cost segregation, bonus depreciation 100% in the first year with the big, beautiful bill. Okay? Overcome your financial doubts through passive investment. What long-term goals does multifamily support for investors? One, if you're looking for early retirement. I had a friend once called me. He said, I'm looking to move out of the country. Because he's like, American money is just so, you can really leverage the power of American dollars in other places of the world. So I got talking to him like, if you move to Brazil, where the cost of living is 1/10, okay? Could you create enough passive income with a very little capital that you could live completely passively, in another word, at 35 years old? At 30 years old. If you're looking to retire early, that might be a route for you. I can't speak on it. Okay, I haven't done it. I haven't helped people do that kind of scenario. But if that's something you want to do, then you're going to have to learn how to passively invest in American dollars, or you're going to have to sell to Americans. It's just really the only way about it. So, but you'd have to work backwards, right? So you'd have to really understand, how much is it going to cost me to live there? Moderately, right? Like, you don't have to live a super luxurious life. How do you live moderately? What's the monthly payment on that? What is that going to cost me a month? And then multiply by 12. Then you got to understand what your 8% return is, to just kind of understand what you need to live completely passively. Next is, if you're looking to build generational wealth. This is a very vague term. It means different things for different people. To me, it's how do you accumulate wealth that will support the entire next generation or two. It's generational, right? So you're really looking at doing, how do you get 10, $100 million? You could do it with 25, 50, $100 million in liquid cash to be able to deploy into the market. Also, finding the right investments that'll last you past your lifetime. Very important, because we talked about passive investing earlier. So multifamily in particular allows you to invest in an asset that will be standing when you're dead, and plus another model that the family office can then adapt and deploy into the market for them to build generational wealth, right? There's no legal or accounting advice. If that's something you're looking to do, we can talk about it, but you have to schedule with the link below, okay? And real quick, before I end on that, it's creating a predictable financial infrastructure for that wealth to be deployed. So, like, I mean, it's not necessarily not that way with multifamily, but when you pass it on, you can dedicate a certain amount of your wealth to go into multifamily and still receive all of the benefits that you get into the next generation, including protected by hard asset, bonus depreciation, cost segregation, basic business model, the need for people to live, just some of those things to take into consideration. What do passive investors usually misunderstand about risk? All real estate has risk. All investments have risk. It's the only guarantee I can make you is there's always risk. And the key is to mitigate that risk with experts and educated advice, okay? The ability to have a framework and operations that surround strictly on the success of a multifamily property, an entire team that dedicates their life and success to having the right, to finding and operating the right assets, okay? Instead of just doing it by themselves. That in itself, we mitigate risk in itself by getting in experts that know what they're talking about. That's literally risk mitigation. It's by getting experts in the field that know what they're talking about. It's more risky for you to go in by yourself. Okay, so really take that into consideration. And then really like understanding risk mitigation and why we mitigate the risk the way we do through insurance, right? That's if something catastrophic happened to the building. Reserves are built in case we don't meet the business plan on time. They're built into the syndication, okay? The insurance and the reserves are built into the syndication through money, and then operators matter more on the deal in particular, where we talk about our grassroots experts that are in day-to-day in the building itself. We can talk more about like how we mitigate super granular things, but that's really, really market specific. If you want to learn that with our team, you'll have to schedule with me below. I'm not sure. We'll have to make sure there's a link, but it's, that stuff's included in our CapEx budget as well. Why do investors feel behind financially despite high income? Okay. If you feel like investors might feel like they're lacking leveraged returns. So whether you're in business or, however you're receiving income, really, any way that you're receiving income, how can we compound it and have it compete with inflation and the continuing rise of basic costs? So multifamily is one way. It's one strategy. It's not the only strategy, okay? But multifamily, we're able to leverage 65% of a property's value by bringing in agency debt. That is one way we leverage your wealth into a higher, more expensive asset that produces cash flow that we have some control over. So forced appreciation, that can help them not feel behind, but taxes are going to kill you. It's the biggest destroyer of wealth. You can use the multifamily cost segregation and bonus depreciation 100% in year one thanks to the big, beautiful bill to help mitigate not just against the income of the property, but on your personal income as well. And you can take advantage of that stuff today. Create a tax strategy today and stop being resentful of the tax bill, and watch how we can, we know the right guys that can help it go to zero. Okay. Yeah. So that's it for that one. Yeah. What emotional patterns affect investors' decisions? The fear of loss controls every decision an investor makes. It's not the dreaming of gain, it's the fear of loss. The losses, the bad partnerships, and the what if I lose everything. The fear of loss, it's the losses, the bad partnerships. What if I lose my entire wealth portfolio? Those things run through an investor's head. And not only just as an investor passively, but if you're the owner or operator currently of a multifamily, there's loss of not being able to exit the property. There's still fear there. And we try to help with that. So when it comes to passive investing in these deals, we're trying to eliminate analysis paralysis, okay, forever, because we have the right team to come in and vet and underwrite the deals. And we have experts in the field who are dedicated to the success of these deals, okay? You don't have to do any more of the analysis. We let the experts handle it. We mitigate the risk by managing, underwriting, and overseeing the asset. So you can just collect the check, and live your life. Okay? That's our goal here, is to help you become the best passive investor. Okay? And then lastly, like really jumping at high projected returns instead of the fundamentals of a deal. How do we get the right people in to oversee a successful business plan? I mean, investors are savvy people. They're intelligent people, and they know that there's always risk in these investments. And that's kind of just the way it is. And it's almost part of the fun of investing in a deal. So we bring on experts to manage this specific property to bring superior results. This helps create we already have a fundamental plan that has worked in the industry yesterday, right? Like what we're doing has worked in the market yesterday. And that in itself helps reduce some of the risk. Just so you can collect a check. Just so you can passively collect a check. What resentment do investors have? Many investors are frustrated with taxes in the United States. That's where you can utilize 100% of the bonus depreciation in year one with the big, fat, beautiful bill. This can add returns to your year-end tax bill. Multifamily is just one strategy to do that. It's not the only. But we can do 100% bonus depreciation. If you've ever been, I can't necessarily speak on this one. I don't have a lot of experience with this. But if you have ever been disappointed with stock advisors, if you currently have money in stocks, if you've lost on stocks, I don't invest in stocks at all personally, so that's why I can't really speak on this. I'm not a stock advisor. But all I can say is with multifamily, we protect it with a hard asset that helps stabilize cash flow that may seem very volatile in the stock market. And it can be paralyzing because we know how fragile the stock market can be. So it's just one way. It's one strategy you can help diversify, but it's not the only strategy. Okay. And the last thing is I think investors are really missing out on big opportunities. We're looking to bring institutional size deals to your doorstep. Because remember, a lot of them happen off market through pocket listings, and they're not going to be found on LoopNet. And we already have the right team who's working day to day in the business to seek and latch on to the best deals on the market. Okay, with industry professionals. Okay, I personally will manage these deals. I'm out on the property. I'm looking at the deals. I'm doing physical due diligence on the property. Okay, and we can bring the deals to you instead of you missing out on opportunities because you're too busy. And then you can passively invest and protect thousands, hundreds of thousands, a million, tens of millions of dollars that can be protected in multifamily real estate. Okay. Protected by a hard asset, 100% bonus depreciation in year one to that big, beautiful bill. Okay. Why do investors feel guilty for not investing sooner? If you've heard the missed compounding years, it's a story about if you start investing now versus the loss potential in investing 10 years from now. It's very dramatic, and it's because compounding interest is an exponential growth. And so when you have exponential growth, between here and here, 10 years can be a drastic loss. And so the more time you wait, whether it's through decision fatigue, analysis paralysis, or lack of confidence, maybe you've lost recently in the past, we can eliminate that for you so you can be more confident and make decisions faster. Okay, so you can act today on the next deal if you wanted to. If you've not invested in multifamily, it might be out of your comfort zone, maybe. This is more individual investor level because you may invest in deals in your local area. You may be in residential real estate. You may be a business owner. Or becoming a passive investor make you feel really uncomfortable because you're giving up control. You have a little bit of control as a passive investor, right? You have the ability to say, I want to put my deal in, or I want to put my capital in, or I don't. But once the capital's in, you have very little say, right? And that's what we're trying to accomplish. I want you to be comfortable as a passive investor. But letting go of control is the only way you can obtain freedom, right? Letting go of control is the only way to obtain freedom. And this is going to be very important if you're looking to retire or exit your current business. Because if you want freedom in retirement, to go into retirement stress-free, you have to give up some of this control. And we're here to help you do that and protect thousands, if not millions of dollars with a hard asset that cash flows that will live past your lifetime. Okay. And then lastly is just really allowing fear to delay decisions. And in the market, these deals are going by within weeks, right? Maybe a couple months, but fear delays decisions because you don't have the right team or processes to vet the correct deals and execute a business plan to success. And you can eliminate the fear and the paralysis by simply giving up control and letting our team come in and vet the right deals with industry experts. Okay. We're going to help you mitigate a lot of risk just doing that, and allows you to have the right confidence and go into a deal like that. Okay. Invite freedom by letting go of control, my friend. Okay. Talk to us about, I'm going to pause. We are helping investors create financial security, especially going into retirement, by protecting thousands or millions in wealth, by protecting it by a hard asset and getting bonus depreciation 100% in year one, thanks to the big, beautiful bill. Okay? We want you to go live your life with your 3 kids and 2.1 dogs. To be completely hands-off and stress-free going into retirement. If you're not going into retirement, just allowing some passive income to help you live and relieve some of the financial strain of the day-to-day. This is one strategy you can use to help provide for your family, especially, as men. That goes such a long way when you can provide some financial security in the home, whether you're at retirement or not. Okay. We want you to live a long, happy retirement life. Because as you're, going back to retirement, specifically for retirees, when you go into retirement, your health's going to become more important. And literally removing stress will help you live longer and live in a happier home. And you can accomplish that through protecting your wealth through a multifamily hard asset. Okay, to receive completely quarterly passive income. So you can live retirement to the fullest. So you don't have regrets at your deathbed. Listen to me when I say this. Damn it. Let go of some control and invite freedom into your life. Okay? I understand financial security looks a different way for people. This is one strategy. It's not the only. And then when it comes to long-term generational planning, if you're looking to have wealth for generations after you, you can look at it in a few different ways. One is just the hard asset of real estate that will live past your lifetime into the next generation, which means the ability to produce cash flow past your lifetime. And then two is really, it's an investment vehicle that you can invest large amounts of wealth. It's something you can, leverage and protect large amounts of wealth with a hard asset. With all the additional benefits that multifamily brings. Okay? Really just the protection of large amounts of wealth. Large amounts of wealth that you can protect with a multifamily asset that you can then diversify into other markets as well. Something to consider. And then it's something you can pass on that can continue to be a vehicle to continue generational wealth. Okay, but it's really important that you plan that because it won't last 3 generations. It's just the fact, right? Probability. So don't be stupid and ignorant to think that it won't happen to you. That's for a very specific set of people. If you're in that, then we can talk about it further. You just have to find my link. How does health impact investment decisions? The fear of loss controls everything. Providing mental clarity improves decision making. Okay, and we talked about potential loss on the compound graph. Okay, I can literally improve your mental health and set you into retirement worry-free if you let me and my team allow you to passively invest through multifamily real estate. I can literally improve your mental health by allowing me and my team to help you invest passively so you can let go of control and invite freedom, my friend, into retirement, whatever you're doing. Even if you're just 40, I can bring some of that into your life. Extreme happiness. Extreme happiness. If you're preparing to retire or retire early, you're probably looking to fund your lifestyle and fund your health care. As it's probably going to be, it's usually more important when you start talking about that. Your legacy will become more important as you look into retirement. And just allowing you to begin to fund all this completely passively so you can be fully attentive to your life and be whole and love your family to the fullest instead of having to exchange time to do that. But you have to allow me to help you do that. Okay? Each deal is specific in terms of the numbers. Depends on who you are. But this is one strategy. It's not the only strategy. Okay? And really protecting large amounts of wealth. I talked about this. Fully vetted, institutional size assets protect super large amounts of wealth with industry experts just so you can live your life to the fullest and prepare your life for the next generation. Okay?